What's up, millennials? So in this video, we're going to take a look at the valuation of a company called Origin, and this is the world's leading carbon negative materials company. Origin is going to be acquired by a SPAC that's currently trading under the ticker symbol AACQ. Now, before we start, if at any moment in this video you don't really know what I'm talking about, please check out my SPAC guide, which I released a few weeks ago. Today we're going to be taking a look at the method number 1 of this SPAC guide, and the link is going to be in the description beneath this video. Also, if you want access to the Excel sheet I'm going to be using today, you can join our Discord for free to get that Excel sheet. If you just go to nesami.com/discord, you can leave your name, leave your email address, and you're going to get access to it. And as always, don't trust me, verify me. I'm just documenting my journey here on YouTube. I'm certainly not a financial expert. Let's first of all talk a little bit about what Origin is, more or less. And as I've said in the beginning, it is world's leading carbon negative materials company. Now, the world's leading part might be a little bit misleading in my opinion, because they don't really have any revenue just yet, but they might just be one of the very first companies that is looking into this sector. This company, Origin, was actually founded in 2008, so they have already been around for quite a while without producing any revenue. But it is quite an interesting company, I think. Instead of using traditional carbon, what they do is they use what they call an untapped carbon ocean. They are looking at atmospheric CO2, which is within trees and plants as well. Because what trees and plants do is they capture CO2, and while Origin wants to take out the carbon and then use that for carbon negative materials. And with regards to the timeline of Origin, we can see that they have already started the construction of their plant, but they're going to start the production in likely 2022, so next year. And we can also see they have already multiple partnerships with some major companies actually, like Nestle, Danone, and PepsiCo. And about the merger date, we don't have any date just yet, but they do expect to close this merger somewhere in Q2 of this year. And if we look at the pro forma valuation, we can see that as almost all the SPACs, they started out trading at $10 per share. And we can also see that they are going to have 184.3 million shares outstanding after the merger. So those are the numbers you can already put in your Excel sheet over here. And then the Excel sheet is going to calculate the pro forma market cap for you, which basically is the market cap after the merger has been completed. So we can see that that is simply going to be 1.8 billion more or less. And then we can also see that they are going to have $863 million in net cash and also $20 million in net debt on their balance sheet. So the net cash position is going to be 843 million, which is the number you can put over here in your Excel sheet. And then you can see that if you take that market cap of 1.8 billion, subtract the amount of net cash of 0.8 billion more or less, then you're going to arrive at an enterprise value of about exactly $1 billion. It's a slight difference with the investor presentation, but it's just because of some rounding differences between the Excel sheet and the investor presentation. So that shouldn't be a worry for you. But if we go into trading view, we can see that they are currently trading at $10.75 pre-market. So that is the number you can put over here, $10.75. So that means that the pro forma market cap has gone up a little bit, of course, to about $2 billion. And the pro forma enterprise value has gone up to a little bit more than $1.1 billion. Then the next step is going to be to determine the future enterprise value. And for this video, we're going to be taking a look at the numbers of 2026. So this is, of course, in the future. We don't know if this is going to happen for sure. But yeah, it's just an expected number that is produced by Origin. So we're going to need two numbers for this calculation, which are also the numbers you're going to be plugging into your Excel sheet. First of all, we're going to be taking a look at the EBITDA of 2026. That is the year we are going to be checking out. And then we're also going to apply a certain range of multiples to that EBITDA. Let's first talk about that EBITDA of 2026. In the investor presentation, we can see that they don't expect to have any revenue for the next couple of years, but then they expect to ramp up quite significantly. And then in 2026, they expect, and of course expect is a very big word, they expect to have $830 million in revenue by that year. And in that year, they also expect to have $296 million in EBITDA. So that is actually the number you can already put in your Excel sheet right over here, $296 million. Then the other number we need is a fair range of multiples. And for that, we're going to do a comparison between Origin on the one hand and other similar companies on the other hand. Let's actually take a look at what a fair multiple could be for Origin. So in this row over here, we can see the enterprise value to EBITDA ratio of 2021 and also of 2022. We're going to be taking a look at the 2021 numbers. So those are these numbers, 20.6, and here this number, 30.3. What does that mean? Well, basically, if you take the enterprise value of these companies, these specialty chemicals companies like Albemarle, Croda, DSM, and Novozymes, if you take those enterprise values, divide them by the amount of EBITDA they have, then you're going to arrive at 20.6x. That is for 2021, of course. If you look at biochemicals company and biomaterials companies, if you do exactly the same thing, you're going to arrive at a multiple of 30.3x. So that could actually be an interesting range of multiples to look at. And Origin says exactly the same thing because they, in their investor presentation, are also using a range of multiples from 20x on the low end and 30x on the high end. So those are actually the numbers you can put in your Excel sheet over here next to the low multiple and next to the high multiple. Then the Excel sheet is already going to take care of the calculations for you. It's already going to calculate the future enterprise value. And that's going to do that by taking that EBITDA of 2026 of 296 million and is going to multiply that by the low multiple of 20x to arrive at a future enterprise value of $5.9 billion. And it's also going to do that exactly the same thing with the high multiple of 30x to arrive at a high enterprise value of $8.9 billion. Then you can also say, well, let's take a look at the midpoint valuation, which is basically the average between the low enterprise value and the high enterprise value, and that would give you a number of $7.4 billion. But this is the future enterprise valuation of 2026. We want to know what the current enterprise value and the current price per share would actually be for this company. Because the thing is, again, remember, this is method number 1 of my SPAC guide. We have been taking a look at the multiples of companies in 2021, and we're now applying that to the EBITDA of Origin in 2026. So there's a discrepancy between these years. We now need to go from 2026 back to 2021. How do we do that? For that, we're also going to need two numbers. First of all, we're going to need the amount of years to discount it back towards the present. That is going to be quite simple because we were looking at 2026 numbers. We are now in 2021, so those are 5 years in difference. But what you can also do in the Excel sheet is simply type in here 2026, and then the Excel sheet is going to take care of that as well. We are also going to need a discount rate, and in this case we're going to use a discount rate of 20%, which is in the investor presentation of Origin, and which is also a very common discount rate in the world of SPAC valuations. So those are the two numbers that you need. If you plug these into your Excel sheet is going to take care of the rest of the calculations for you, but let's actually do that manually as well to see if the Excel sheet is actually correct in calculating these numbers. So first of all, what it does is it takes this low enterprise value we just calculated in the previous step, $5.92 billion. It's going to divide it rather by 1.2. The 2 here is standing for that discount rate of 20%. And it's going to do that to the power of 5 because of those 5 years we need to discount it back from 2026 back to 2021. And if you then execute that calculation, you're going to arrive at a current enterprise value or a discounted enterprise value of $2.4 billion more or less. So that is the number which is in your calculator and also the number which is in your Excel sheet if everything is all right. And then it's going to do exactly the same thing for the high valuation. So for the high future valuation, we said it's going to be $8.88 billion divided by 1.2 to the power of 5. That gives you about $3.6 billion in the calculator and also in the Excel sheet. And then the Excel sheet is also going to calculate the midpoint fair valuation. So that is simply the average between this number and this number, which is almost $3 billion. But that is the enterprise value. We, of course, want to know a fair price per share. And first of all, for getting to a fair price per share, we first need to determine what a fair market cap would be for this company. Well, the only thing that you need is to take that enterprise value, add back the amount of net cash they are going to have on their balance sheet after the merger, which we said was $843 million, and then you're going to arrive at these fair market caps. So for the low end, 3.2 billion, for the midpoint valuation, 3.8 billion, for the high valuation, 4.4 billion. And then the only thing you need to do is to take those market caps, divide them by the amount of outstanding shares, which was 184.3 million shares outstanding after the merger. And then you're going to arrive at these fair prices per share. So for the low valuation, you would arrive at a fair price per share of $17.48. For the midpoint valuation, $20.71. And for the high valuation, $23.94. So based on these calculations, that would mean that Origin currently is actually undervalued. Of course, don't trust me, verify me, check what I'm doing, check if everything is alright, and also check if the range of multiples is correct according to you as well. Also keep in mind, we have been taking a look at assumptions. We've taken a look at numbers from 2026. These could be entirely wrong. Maybe they're higher, maybe they're lower. We just don't know. And again, also the range of multiples is going to have an effect on your calculation. So if you change one of those variables, if you change the EBITDA, the range of multiples, the entire calculation is going to change and your fair price per share is going to change as well. With that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.